All right, we kicked off Monday, April 28th, now next later. Sasha, welcome to the show. How's it going?
It's going well. How are you?
Good, thanks. We are live, and thank you everyone who joins us live. This will be a great episode to utilize the chat and the Q&A. When Sasha and I started this show, part of what we wanted to do was obviously have guests on and learn from the industry and pick the brains of the best people on these topics of innovation, product development, technology, and data management. But we also wanted to inspire. We wanted to inspire people to new ideas. We wanted to inspire startups to work on the hard problems in our industry and inspire lenders to take on those challenges and take on those business partners. So today, Sasha, I was thinking about it that way for this topic, which is, how do we inspire folks to think differently about some critical areas of underwriting data? And a lot of times, now, next, later, we have 30 minutes. It can be hard to go deep on a particular topic with a guest because we're trying to capture all the context that the audience needs. But today I thought, no guest, let's go deep underwriting data. And where is it today? Where do we think it's going? And then maybe some thoughtful guesses about where it might end up. And I can add a little more context from my end. But how's that sound for today?
Yeah, it's a great conversation, and I think it's a good illustration of so many areas where we should be challenging the status quo and pushing people. I'm both excited and nervous to be getting on stage at Mortgage Innovators to do just that. I don't know why I agreed. If Paul's on, Paul, I'm like, I love you and hate you all at the same time for making me get up and do TED Talk style of like, why we need to lean into technology and AI more. And so I feel like this is a nice illustration of an example, one area that you can look into that we've already made strides and need to continue to lean into because it's working. And then where else can you apply kind of same theme of innovate, disrupt, but don't just say those words, actually go do it.
Hmm. Well, I froze. I don't know if you can hear me,
I
but
can
there we
hear
go.
you.
I'm back.
Okay.
So hopefully that doesn't happen again, but we shall see.
I mean, I feel like the pause was impactful. You were just like
What?
so taken by what I said that you couldn't help yourself but just
That's
have that long pause.
the power of silence, right? As a speaker and an author, you know the power of the silence from stage. We're just applying it here. But I think now and next are really, I like in innovation to use the concept of brackish waters. I always like to talk about now and next as kind of like always overlapping and mixing in many ways. And today's topic, I'm still getting a lot of questions, and I still hear from lenders and technology companies, about underwriting to the Fannie Mae token. And I don't mean to call it the Fannie Mae token. It's both GSEs for sure. But this idea of importing income employment data, asset data early and holistically to capture right then and there everything you need. And the reason I thought it would make a good topic for today is, well, I guess there's two reasons. One is a tad self-serving, so I'll just admit it up front, but I just completed a white paper with the MBA on rental history, rental payment history. And I
Yeah.
really want to dig into that in that space of where now and next are mixing. But the reason this is a good topic for our audience, we have, a lot of people on here in product, in capital markets, in credit policy, thinking about how these things work and how you move your organization, your business partners from where we are today to where we're going. And I think where we are today is tough because we've spent a decade or more. I would say at this point, you could almost argue we're nearing 20 years, but it's not quite there. It's about 17 years of getting as little documentation as possible for a GSE approval. And I know that's hard for some people to hear. They're like, no, there's much more rigor to it. But all the incentives for the last 15 years were get as little as you need for the approval, and as soon as you have it, move it on. Don't go looking deeper because that could throw everything off. That could create a non-approval. That could do this. That could do that. So maybe, Sasha, talk a little bit about what you're hearing
Yeah, I
in
think
that same space.
Yeah, I mean, I think, and you brought it up in a separate conversation, so I don't want to jump the gun, but we are seeing more and more information and data that shows that our typical look at a profile of a borrower doesn't always paint the picture
Hmm.
accurately, we'll say. I've been working in a company that involves credit, trained not to say the word accurate, so I get very gun shy about using that word. But nevertheless, it's true, right? Looking at a credit score and history payment to some extent does give you some part of the picture. But we're seeing that, DTI is certainly a significant one, delinquency data, which both can be tied together. To your point, rental history, if somebody didn't have the privileged ability to own a home before, you're not going to have that history. So how can we look at other things that you have done, like making a rental payment every month, on time, in full, et cetera? I think there's a lot of folks that don't have a great credit history because they didn't have credit in general. And so then you can't just use a credit score to look at somebody's profile and understand who they are as their ability and willingness to repay. It's not enough. We know that. So even though, to your point, there's this fast track, we've got, the easy documentation, get things pre-approved, day one certainty, et cetera, that can push things through the funnel quicker. And that's great. There's a lot that we're kind of, I'll call it, keeping the blinders on, not opening up to realize that there's more to an ability to pay, a willingness to repay from a borrower that doesn't show up from those, call it, more traditional documents.
Yeah, there's two things I hear from a lot of clients. One is I'm really nervous to pay 2 or 3 times for underwriting attempts or technology pieces that I need to do the underwriting. So we know one of the big obstacles in this industry right now is I waterfall to try to save money. And if I waterfall to try to save money, I'm probably not doing the best approval service I could, but
Mhm.
I also have to do that because I can't pay 30, then 35, then 50, and now I'm at like $120 because I tried this, then I tried that, then I tried this, and I'm paying for all these services, and I just can't afford to do this. So we really have to talk to lenders and talk to technology providers. How do we think about that differently? How do we incentivize? I think the GSE should be thinking about this. How do we incentivize doing the right data pool upfront holistically? I think the second thing that I really like about this topic is I think this is where purchase and refi can work together. Often in this show, you and I talk about how you have your kind of like purchase incentives and purchase programs, and then you've got your refi work. And last week, we talked to Nate Denherter at Ardley about how you pull from your existing database the data you already have, populate your fields in origination, and then you only have to either refresh, update, or fill in something that's missing versus getting a whole new application because you're leveraging data that's already there. And I know from your work, you can pull contextual data about someone. Soft pull maybe is a good example, but there's a ton of other good examples of data sources you can pull through your verification partners to populate a profile and further limit what the person needs to put in. So I think like that's the second thing is if you're doing a purchase refi application, you want them to look as similar as possible. The only key difference is with purchase, you're pulling in that data from elsewhere, and with a refi, you're pulling it in from your own sources previously. But it's a fundamentally the same data fields that then move, into the GSE-AUS to give you that feedback. So this is an area that I think has pretty good overlap for ops folks.
Yeah, absolutely. And it's interesting because as you're talking about it, and I've been preparing for this talk, some of the conversations I've had with lenders is like the impatience of an LO that just keeps hitting the work number until it comes through and then you end up paying for it 3 times, right? Or to your point, yes, a waterfall is great, but unless you have it configured in a way that truly works for you, it is just a kind of middle road solution. However, we are seeing people starting to get more trending data from, depending on attributes, whether it's loan program, borrower profile, et cetera, GSE requirements. What's the best waterfall to work for that scenario? And so I think that question then becomes exactly what you're saying. How do you just become more intelligent in the business decisions that you're making? And you do that through leveraging the right data at the right time. And that data we need to be thinking in a more outside the box, not just traditional manner on, do we have all the right data inputs, and are we looking at the data the right way? Because I think oftentimes we just get stuck in we've always done it this way. It works, keep it going. I don't want to retrain my operational staff. I don't want to redo my processes. And so we don't really test what the data is showing us to figure out a better way to leverage that data to make more informed decisions. And I think we're starting to see more movement towards that. Lenders require, in my mind, technology partners that can give them help, right? Like this is not
Mm-hmm.
just let me solve it on my own, because you're already gonna have to deal with the operational side of it, which is a pain in the butt. And so it's nice to have technology providers that can give you half of the puzzle, but then you do, as a lender, have to be willing to try. And I know it's not easy to do that, especially in markets that are as volatile as this one. However, now is the time, because it isn't crazy upcycle. You have more time to look at that data and play with it and get more creative. And hopefully you start to find solutions that, again, I keep using the word intelligent, smarter, but that's where we need to get to.
Yeah, that brings up, I think you nailed it on that second critical strategic decision, that fork in the road that you just identified for the operations folks, which is honestly, it's the purchase product where you kind of get the most bang for your buck for the day one certainty token, for these asset tokens, for this, asset and income AIM type token for Freddie. Like that's where you get the most because you can get it all up front and you're good to go. But it's refi that seems to be the one everybody wants to start with because it's easier. I can control it. There's only two parties, my customer and me, and I can make that fully digital to avoid the PDFs at least in that case. So ops folks out there, if you're working with your technology and product team, it's hard to decide, but you have to decide, do I practice on refi because it's a little bit easier and then move to purchase, or do I just start with the most value, which is purchase, to get that data, that digital data, to get that token, to have day one certainty, and then let everybody go shopping? I think it's a really tough call, but if I guess also it would matter how your sales folks will interpret it,
Yeah.
to your point as well. But I think that's a key cross section.
I think the other thing I would just challenge again, since I'm in this mode of challenging the status quo,
All
is I hear
right.
a lot of lenders saying right now, well, I don't want to focus on things related to refi because I have so many people that are in that 2 to 3%, interest rate, because we saw an incredible market for a while there, from a borrower perspective, and like they're not going to refi, right? It's like, okay, you're right. No one's gonna. I wouldn't have refied a 2.5% loan either, but life happens, right? I
Right.
had a 2.5% and I got divorced and we had to sell our home. And
Yep.
so, like, life is going to happen. People are going to get married. People are going to get divorced. People are going to pass away. So, even though there's a lot of those lower interest loans out there that probably won't refi, there will be more refis in the future. And when we don't think about problems holistically, to your point, then eventually they come back to bite us in the butt. And so it's like, to me, I think, okay, right now you have an opportunity to look at it holistically and look at what the data can do. And so I like that you're bringing up refi, because a lot of people, I think, are just kind of ignoring refi a little bit right now.
Yeah, I agree. I think the threat that I was most interested in over the last 6 months, and it was probably about 6 months ago, maybe even been a little longer, was when we started thinking more and I started seeing more LinkedIn posts about the threat of large servicers
Mhm.
to whatever you're counting on. I'm going to just pause. If you still have my audio, I'm going to pause until I make sure that I don't lose video here. Should be
Good.
only a
Still
minute.
hear you.
I never know, Sasha, I apologize. I never know how much my audio stays true when my video freezes. But what I was saying was we started seeing a lot of LinkedIn posts, and I thought they were really thoughtful around the threat of large servicers to whatever refi volume you're counting on for this year, next year, and in the future. And maybe either you shouldn't count on it as strongly or you need to up your game to combat that. And so I think that was a really good strategic point for a lot of companies to think about. Oh, I will have these life events refis. I got to stay in front of them. I got to use my CRM partner, but I can't take it for granted. I can't ignore it. To your point, I can't take it for granted because I need to be able to capture that business to hit my numbers for this projections, for the forecasts that I've made on the size of my operation and for what I'm trying to do this year. So I think that is a critical piece for sure.
Yeah, absolutely. No, that's a good point.
So that kind of brings us to the next. And I did want to make sure I talked about rental payment history because it's fascinating to me. It actually is a microcosm of the waterfall problem. what the MBA found in their research was the GSEs unlocked data sources that would allow the lender to submit rental payment history as an augmented data source, which you mentioned at the outset is a exact, not maybe exact's the wrong word, but it's the best comparable we have for a housing payment. If we
Right.
just stopped saying rent payment and mortgage and just started saying monthly housing payment, it would actually probably drive this a lot farther, faster in this industry because you already have a housing payment from your customer. Start thinking about it that way and use it. And the GSEs have said okay to this. But when they did, the actual process flow of submitting it seems to have caused a lot of lenders, especially retail lenders, to wait to see if I can get approved the normal way and then only use it as a second look or as a alternative to denial. And so what ended up happening was, while that's not a bad idea logically to start,
Sure.
what it ended up creating was two unintended consequences. The first and most tragic is you get denied twice as a customer, which sucks, right?
Yeah.
You get denied, and then the loan officer says, wait, let's get this more data and check again. And then you get denied again. And like that is really a bad experience. But then, second, if all I'm doing is underwriting, not getting an approval, adding rental payment history, getting an approval, I am duplicating work. And we've just spent 6 months on this show talking about not duplicating work and becoming more efficient and saving money and time for your people by making it upfront. So I think the paper, if those that are interested want to read it, or just in general, as you think about this, how do we address this waterfall problem of, multiple tiered costs? But if I do everything holistically up front, it can be expensive, time and money. And so we have this tension that is yet unresolved, I think, in the next step of where underwriting happens and how holistic it is. And I'm not sure if you're seeing that from your partners and customers, or, how we should think about it as we talk to
Yeah.
lenders.
Yeah, no, we are 100%. And I like what you brought up. I mean, it's sad, but like the borrower experience, albeit is supposed to be at the forefront of everything we do, sometimes falls behind the operational efficiency because
Mhm.
it does take time and effort to think about how do I change, reconfigure my workflow such that I can do this in a way that's the most effective, not just for my own operations, but for the borrower experience. And if the answer, doesn't meet borrower experience but meets operational efficiency, sometimes we lose sight of how that emotional weight of finding out that you got denied can be for someone to go, I don't want to try again. I'm not interested. Maybe now's not the right time. And then I love your concept of the monthly housing payment or however you framed it in the
Mhm.
vernacular. But, I think about younger generations that haven't bought yet, that have been renting because it's been unaffordable or they haven't been able to, being scared or not thinking that maybe they will qualify because they don't have, the previous mortgage or they don't have previous credit, et cetera, or low income household scenarios. Same, right? Where it's just if I don't fit this old model that has this vernacular that I don't understand. And we still speak in words like DTI, which most people that aren't in mortgage don't know what the heck we're talking about until they go to get a mortgage, right? We
Right.
don't change the semantics and the vernacular that we're using. We could emotionally be driving borrowers away from even considering being a borrower wanting to buy a home. And that's a huge miss. There's probably a lot of prospects out there that we don't understand that we're missing because we're not speaking to them in a way that they will understand. We're not meeting them where they're at. And then we don't have the ability to take them through a process that's a better experience.
Yeah, I think that's a really great point because now I'm even thinking of it from that marketing mindset perspective.
Mhm.
Well, in addition to what we just said, which is, we do have a significant tailwind in mortgage, economically speaking, which is rent is high everywhere. This is
Mhm.
not a market where it's easy to justify renting and it's easy to go back to renting after a home search. Everyone does go back to renting, but begrudgingly because rents continue to go up too. And
Yep.
in many, many markets, the rent cost increase is actually outpacing home price appreciation. So it's like my landlord continues to raise my rent 10% every 2 years. That's a lot after 2 or 3 leases. It gets really hard. And so it isn't like we can just turn back to renting. And this is one of the points I make, separate topic for another day. But this is actually why I think down payments aren't as important as they used to be, because people talk about skin in the game. The skin in the games, there's nowhere else to go. The skin in the game is the mortgage is the best effective tool.
Yeah. No, I feel you on that. And I maybe feel a little bit too close to home because I'm literally paying in rent almost what my mortgage was, but I do not have the same house that I did. I have an apartment right now. So, I can only imagine for others who, I obviously am privileged and do well. And, what about the ones who don't have that option? And to your point, there is no other option. Like there's only so many places to go to live.
Yeah, exactly. I appreciate that. So we do have like 9 or so minutes left. We try to be very efficient on time here at Now Next Later. So I wanted to also talk about how rent payment kind of inevitably leads us to this question of cash flow and residual income. And I think a lot of mortgage professionals that I talk to all agree that if you took a step back objectively and said, what's the best way to know what's going on with someone? Cash flow and how much money you have left over in your account every month is logically the best way to know what someone can afford, why, how. And, cash is king. That's true outside of real estate as well as it is in real estate. And that there's a reason for that. But we are stuck. And this is a thing I've been struggling with a lot, Sasha. And so I was hopeful we'd have some time to bring it up. So I'm glad we do. I've really been struggling with how much innovation is possible when the best we can do is submit to AUS and wait for it to come back. Like
Mhm.
AUS is inherently a reactive technology. It's a reactive process. So are we bound by reactive only
Hmm.
forever until we disconnect 90% of the loans? And I say 90 because most companies are even running AUS to get the FHA
Sure.
feedback as well. It's hard, you don't know. So for the vast majority of loans, even if they end up in FHA, even VA, sometimes you're running it to see and then putting it sort of in the right program accordingly, unless you really have that upfront vetting. But I'll pause on that and just come back to this question of reactive. We're always kind of behind the data because we
Yeah.
have to collect it, then submit it, then wait and see, then address it. And sometimes I'm finding those conditions on the AUS aren't even credit risk or pricing conditions. They're actually just in there to keep lenders honest on what they've done to underwrite that prior to submission. There are conditions that are just like quality control conditions to see if
Right.
anybody's paying attention rather than actually fundamentally. Now, that's not a huge piece, so that's not a major problem for the industry. But I think the major problem is if I tried to do the best thing for people as an advisor to their home equity debt life, I can't because I got to submit and wait and see and then tell them what's going on. And I think we're limited in certain innovation by that. And I don't know if you're seeing that or hearing that on the verification side or just in general, from
Yeah.
community lenders and from other lenders, or if you've thought about it. But I wanted to pose the question for discussion.
Yeah, it's an interesting topic, and I think it's a dynamic, complex one in that it's not linear, right? It's not a one-way street, so to speak. And I have this sneaking suspicion based on what I'm observing and experiencing that it might be a meet in the middle, almost when you think
Mhm.
about in companies when you try and set goals or OKRs or whatnot, like they always say, try and do bottom up, but you kind of have to do a little bit of top down, a little bit of bottom up, and like meet in the middle, right? And I see that, like for instance, we work with FICO and brought FICO Simulator to market, and that's an opportunity on the front end. Instead of waiting to find out, are you going to qualify or are you not? How do I scenario plan with my own particular profile and think about ways to improve my credit before I go borrow money? And there are other, programs, products, applications out there of this where you're starting to see more happen on the front end to become more um, proactive than reactive, to your point. Some of our systems, I think, I mean, look, when we look at a profile to determine do you have the ability and the willingness to repay, we're looking back in time because we have to.
Yeah,
We have to look at
right.
your history. So that's the conundrum of like, you can't get away from full reactive because you have to look back to some extent. But how can we maybe meet in the middle and find ways to make that a little bit more intuitive. And for us in particular, we're sitting down with lenders and having those deep conversations around, okay, how do we do both? How do we take the trended data that you're seeing, the things that are tried and true, but then how do we make it work in a smarter way for you so that you can think about making decisions sooner in the process? Figure out how to do soft pull and get enough data to determine, do I even go further in the application and eventually get to a hard pull for credit, or do I not?
Mhm.
Use a simulator with a customer and think about what those scenario planning ideas are. Is it really time for that borrower to borrow now or not? And so I think you're going to see more on the front end, and you're also going to see the tried and true on the back end. And then you're going to kind of see these two coming towards the middle. And then there's going to be a rub. And ironically, it comes in at that underwriter seat, likely, where we have to figure out, how do we take a more proactive approach on the front end and then get systems on the back end to catch up. And really that just requires us, again, I think, in the trenches, looking at things differently. The other thing you brought up that it's interesting, it came up last week, and my wheels have been spinning, and maybe we should bring somebody on to talk about this, but are there creative ways for us to help borrowers build reserves? Because that is challenging for a lot of borrowers.
Mhm.
And I appreciate the cash is king, and the cash flow you have at your bank at the end of every month is an indicator. And there are people who would do anything to have the American dream, and their cash flow doesn't look great. And they
Mhm.
would work harder at making sure that they have what they need to obtain the American dream, even though their cash flow doesn't look great. So, what can we do? Not just the first home IQs that are out there building financial literacy and helping people understand how, but is there something else that we can do as an industry? Or it's like a call to action, right? Is there
Mhm.
someone out there that wants to come up with a creative way to help borrowers create reserves so that they can be in a stronger position when that time comes?
Yeah, one of the most interesting things I've worked on in my career was actually around resiliency
Hmm.
questions. FICO briefly, and maybe still has a tool or was working on a tool around which FICO scores are more resilient. So you have two
Yeah.
680s, you have two 720s next to each other, but there
Yep.
is a resiliency index that says actually these indicators seem to show a slight advantage. I was even thinking about it, shout out to Andrew Davidson and the Andrew Davidson Company. They work on non-agency product. So
Mm-hmm.
typically that's non-QM, but often it's QM, but just
Yeah.
non-agency. And he found in his research that post-COVID, during COVID and post-COVID, it was actually mid to lower FICO scores who understood how to get back on their feet after a missed payment better than higher
Hmm.
FICO scores, because those customers tend to operate in a cash flow environment month to month more frequently in their lives. And so it turns out if you see one missed payment, you cannot look to FICO as an indicator of what's going to happen next, because a lot of times one missed payment is not determinative for that 680 or that 620 because they know how to manage it, where the
Right.
one missed payment for an 800 might be a much bigger indicator of a serious problem and in their
Absolutely.
life. And so I think you're right. It I'm thinking even now as you're talking that like the pendulum swings back and forth in this industry, right? Like blockchain is hot, then it's not. AI is hot right now, but the topic you just described that could come back to being cool again is data science, not
Hmm.
AI or blockchain. Like, how do we do better propensity? And I think Kirk mentioned in the chat, and I really appreciate everyone using the chat always. And that is, let's meet in the middle, to Sasha's point, and practically speaking, how do you use simulators? How do you use propensity to get approved so that you can know up front, all right, I have maybe three versions of the Jetsons treadmill to get through my pipeline. Which one do I use for the right people, thereby saving money, but
Yeah.
still being able to serve everyone without these kind of waterfall issues or without these double denial issues? Get that simulator, get that propensity model in place, and then put people on the right track. And then you can staff those tracks accordingly, uh,
Right.
and really start to drive efficiencies
I
in.
also think you're not going to see the fruit of AI to the extent that we could if you don't get the data right first.
Yep.
Same thing as technology. If you put technology on top of a bad workflow, guess what? It's not going to work.
Yep.
So you got to clean up workflow in order for technology to come in and help support. You got to clean up your data in order for AI to come in and support, right? The AI can only do so much. Machine learning can only do so much. We can only train things on data if the data is trusted and reliable. So I love that idea of getting back to data science. I think it's something that we were really leaning into for a while and then came off of, but I know we are. I wish there was more I could share about some things on our roadmap that I'm really excited about, that we're coming to market with hopefully this year, that will change the way that data does. Again, make it work for you. You have the data, whether you're a lender or technology provider, et cetera. You have lots of data. Put it to work for you.
Yeah. Well, as those are announced, we'll talk about them here. So everybody come back, listen to those things like as they come up. We're obviously going to, this is a conversation that comes up in a lot of different areas of our industry. So on Now Next Later, it's going to come up quite a bit. I'll just close with this. Like when I was at Rocket Mortgage, the CEO, Bob Walters, would always remind us that the process is producing the results it was built to produce. So if you're not getting the results that you want, go back and look, because these processes are agnostic. They are built, they produce something. So if the system's producing a result, go back and look at the system if you want the result to change, because it is producing the result that you built it to do. And so we're constantly refreshing those processes here on Now Next Later, and hopefully in your businesses. So reach out to us with topics, reach out to us with guests. I love this topic, Sasha. Thanks for indulging it, because I think this is really, really important.
Yeah, it was a great conversation, Jared. Good to see you.
All right, good to see you too. Have a great week. Thank you, everyone. We'll post this to YouTube and we'll see you again next week.